Let's be real. Last quarter probably felt pretty scary, right? All the headlines, the numbers, it's a lot. But what if the problem isn't the market at all? What if it's just your brain's default wiring? Today, we're going to build a super simple rulebook that actually uses that wiring against itself. This is all about design, not a battle of willpower. Let's get into it.
This right here is the classic trap. We see a hot quarter, we jump in, we see a terrible one, we panic and get out. It's totally exhausting, and you know what? It's usually a losing game. The goal today is to break that cycle, for good.
And there it is. It's a real thing. It's called recency bias. And it's not a flaw in your character, it's literally a feature of being human. Your brain gives so much more emotional weight to what just happened than to, decades of history. So we're just gonna design a system that knows this and works around it.
Look, you do not need to read another market forecast. You don't need to watch another talking head screaming on TV. For busy people, you need a system that just filters out all that noise and makes the right action automatic. The whole point is to make the best decision the easiest decision, which, let's be honest, is usually doing nothing at all. This right here is the core philosophy. Relying on willpower to stay cool during a market crash, it's like trying to stop a tidal wave with a beach towel. It's just not going to work. A well-designed system, a clear set of rules you wrote when you were calm, that works on its own, especially when your emotions are going haywire. Okay, so part one. Before we can build our system, we gotta understand the materials we're working with. And that means learning to see time the way that data sees it, not the way our gut feels it. Meet the villain of our story, recency bias. It's that little voice in your head screaming, "This time is different," just because of last quarter's news, making you totally forget about decades and decades of data.
And here's our hero, base rates. This isn't about feelings or forecasts. It's just about the odds, the long-run history. Base rates are the perfect antidote to all that short-term panic and hype.
So take a look at this. This is how most people experience the market. See it? It's all over the place. Up 1 minute, down the next. This 12-month view is pure noise. It's emotionally chaotic, and trying to make decisions based on this, well, it's a recipe for disaster. Okay, but now let's just zoom out a little bit to 36-month chunks. See how those jagged edges are starting to smooth out? The really crazy swings are getting less frequent? You can start to see a real pattern emerging from all that noise. And boom, look at this. At 120 months, that's a 10-year view, the whole picture changes. The returns are anchored, they're stable, they're tightly clustered. This is the base rate in action. This is the predictable reality that all that short-term noise is trying to hide from you. Remember this, short windows swing, long windows anchor. All right, so now that we know how to look at the data, let's get to the fun part, building the engine of our system. This is your core strategy, your anchor, the part you almost never, ever touch. And don't worry, it's super simple. Just 3 steps. We're going to pick a core portfolio, decide how much we're allowed to play around the edges, and then, this is so important, we're going to write it all down. Step 1, choose that baseline. And seriously, don't overthink this. Just pick a simple, broad, globally diversified mix of stocks and bonds that you can basically forget about for decades. Something like this 70-30 split is a classic, tried-and-true starting point. This is your home base. Step 2, cap the tilt. Come on, we all get tempted by the hot new thing, AI, clean energy, whatever it is, and that's okay, but we have to put a hard limit on it. Decide right now that you will never put more than, say, 20% of your stock money into these little side bets. This is what keeps one cool idea from blowing up your entire plan. And now for what might be the most important step. Write it down. I'm serious. An unwritten rule is just a vague suggestion your future, panicked self will ignore. Get specific, just like this. Make your rule real. All right, this might be the most powerful part of the whole system. This is the emergency brake. This is what stops you from tearing up your entire long-term plan just because of some scary headline on the news.
Think of it like a bank vault that needs 2 separate keys. You are going to decide on these keys ahead of time when you're calm. Key A is some big economic signal, like inflation staying above a certain number for 6 months straight. Key B is about your own portfolio, when its long-term return hits a true historical extreme, like the worst 10% of all time. And here's the rule. It's non-negotiable. If the news is screaming about inflation, so Key A is turned, but your long-term returns are actually okay, Key B is not turned, what do? You do
nothing. The default action is always no action.
But only when both keys are turned at the same time, the world has truly changed and your portfolio's long-term results prove it. Only then have you earned the right to even sit down and think about reviewing your core plan, not a second before.
Okay, theory's great, but it's all about making it happen. Let's make this entire system run on autopilot so you barely have to think about it again.
This is it, your 20-minute action plan. Go to your brokerage account right now, set up an automatic monthly investment, turn on auto rebalancing, open the Notes app on your phone, and type out your policy line and your 2 keys. And last, create a calendar event that repeats every 3 months called Check Base Rates. That's it, you're done. The system is installed.
So if you remember nothing else from this, remember these 3 things. 1. Short-term charts are for feelings. Long-term charts are for facts. 2. Build your plan with a stable baseline and a small, disciplined tilt with strict rules. And 3. You never, ever change that baseline unless both of your keys are turned.
So I'll leave you with a question, and I'm really curious to hear your thoughts on this. When it comes to rebalancing that little tilt part of your portfolio, what's more important to you? Having a wider band so you maybe pay less in taxes, or a tighter one for super strict discipline? Let me know what you think in the comments.
Hey, if you found this system useful, a like and a subscribe would be amazing, and you're definitely going to want to stick around because in the next explainer, I'm going to share a simple 1-page dashboard that does all this rebalancing math for you automatically. It's the perfect tool to go with the rulebook we built today. I'll see you then.